Good evening, Jacob.
Thank you for coming in. Does this vindicate Liz, or is it more of a new problem that this government has to tackle?
It certainly is awkward for those who said Kwasi Kwarteng and Liz Truss were being irresponsible because, as you say, government borrowing costs are now well above where they were back at the time of the mini-budget, even though we haven't got the pro-growth, low-tax policies that Truss and Kwarteng wanted. What you've just said, you've expressed it very, very well, but I think it's worth going through it again in smaller steps, if you don't mind, because we really are at the nexus of high politics and high finance here. So let's walk our readers, our viewers and listeners through this. We had this morning, Jacob, some GDP numbers. What's that? That's the size of the overall economy. It turns out that the UK is still growing, even though the Eurozone's in recession. So between January and March, UK GDP expanded by 0.1%, small, but better than a contraction. And then in April, we had a 0.2% contraction. That means the Bank of England won't need to worry too much about slowing the economy if it raises interest rates even more. Then yesterday, we had wage data, and this really worried the Bank of England. In March, wages were 6.7% higher than March 2022. In April, they were 7.2% higher. Still less than inflation, which is 8.7%, but that's the fastest rate of wage growth in over 20 years. And that's what's really spooked the gilts markets over the last 24, 48 hours. And let's have a look at that graph again that you showed. In fact, the graph that you showed, since we made that graph, the two-year gilt yield has gone up even more. As we can see, at the time of the Truss-Kwarteng budget, the peak was 4.61%. That's what investors demand from the government a year to lend money over 2 years. It went above that, 4.63. At one point today, Jacob, it was 4.91, almost 5%. And that suggests that financial markets are concerned about the amount of money the British government is spending, the amount of money we're borrowing. They're also predicting, as you well know from your financial background, that the Bank of England is going to raise rates, unfortunately, quite a lot more than where they currently are.
And that's really at the heart of the matter, isn't it? That the Bank of England was slow to raise rates and therefore has to do more to catch up. And if you look at what the Federal Reserve did, it went faster earlier and is now reaching the end of the interest rate increasing cycle.
Indeed. Inflation in the US is now below 5%. It's still 8.7% here in the UK. We'll get another inflation number, won't we, next Wednesday, and then another Bank of England interest rate number decision next Thursday. We've learnt in the last hour the Fed has, because it's done so well hammering down inflation, because it did move fast and it did increase interest rates rapidly and with real gusto, showing a lot more courage than the Bank of England, by the way, a lot more self-awareness than the bank who kept saying for months and months, oh, don't worry, old boy, inflation's transitory. The Fed has tonight been able to pause its rate rises.
And this is really risky because you referred to the income rise. Once inflation gets embedded, you get a self-fulfilling circle, don't you?
You
get inflation rising, therefore incomes have to rise, and therefore interest rates have to go up much more than would otherwise have been necessary if the bank had acted earlier.
That's exactly right. You and I have spoken about this privately. We're almost the same age, and we both watched in the 70s as young people, reading the newspapers, watching the tea time news. In the late 70s and early 80s, we did have in this country a wage price spiral. That means wage claims go up. That pushes up firms' costs because they have to pay those wages. They pass those costs on. Prices go up, which means wages go up again. We are now in a wage price spiral here in the UK in a way that the US is not, and the Eurozone probably isn't either. The Bank of England has a real problem now to get its arms around inflation. The European Central Bank, inflation's much, much lower. They have to raise interest rates by less because they have less of an inflation problem. And as you know, Jacob, this cost of living crisis, Sunak's saying we want to bring inflation down to half of what it was. That means about 5% from 8.7 now. If he doesn't do that, then he is going to have a major political problem as the general election approaches.
But it's a major political problem either way, isn't it? Because if interest rates have to go up more, the effect on people's mortgages, many of which are coming to the end of fixed-rate periods when they were at very, very low rates, and the change from the 70s and 80s is that people used to be on floating rates, so the rate change came through very quickly. Now, people are going in one fell swoop from a very low rate when interest rates were at 0.25% and they fixed for a few years to fixing on a 5.75, 6% base rate.
Exactly right. It's worth just using some more numbers, if people can stand them at this time of night. There are 11 million mortgages outstanding, roughly, in the UK, and 8 million of them, you're right, are on a fixed rate. And that sounds, oh, that's safe, people are insulated. But, Jacob, every month now, between 150 and 200,000 households are coming to the end of fixed-rate deals, and a lot of these fixed-rate deals will be 2-year and 3-year and 5-year deals when rates were much, much lower. If it's a 2-year deal, rates are almost zero. And so people, particularly young people, often young householders with children, people who have stretched themselves to buy a home, to raise a family, we know how difficult that is these days, how unaffordable it is for so many households. They're now going from very, very low rates of interest to 5, 6, 7% rates of interest. Because these numbers that we've been talking about, Jacob, the Bank of England's base rates, the 2-year gilt yield that the government borrows at, these are by definition the lowest interest in the economy. The commercial interest rates that firms and indeed households are faced with are always much, much higher because of the profit margins.
They have to pay a premium on that,
Indeed.
and if this is happening, then you risk the property market, and you've got the private rented sector being hit by law changes, and, of course, interest rates hitting those who have buy-to-let mortgages. You've got homeowners finding that they're hit. This is really difficult for the government because people's incomes are squeezed and their asset values may be squeezed as well.
Absolutely. And we are in a completely different world. 2 or 3 weeks ago, we often talk about in politics, it's the economy, stupid, that matters. 2 or 3 weeks ago, the money markets, you saw it there from that gilt curve that we put up earlier, the money markets were predicting that Bank of England interest rates at 4.5%, where they currently are, having gone up in very small increments, as you said, the Bank of England has been very timid. The money markets thought that interest rates had peaked, that 4.5% would be the peak. Then that April inflation number came out, 8.7%, down a bit, but core inflation was up. And then these really big wage numbers earlier this week. The money markets are now predicting that Bank of England interest rates are going to go up from 4.5%, where they currently are, all the way up possibly to 6%.
Yes.
And if you have a 6% base rate, it gives me no pleasure to say this, mortgage rates start with an 8.
And at that point, the economy is in real difficulties, and we've got a low-growth rather than a pro-growth economic strategy to go with it. Oh, dear. Well, thank you very much, Liam. As always, I want your thoughts. Mailmog@gbnews.com. Coming up.